Welcome to my office. Do you sometimes wonder what all these statements and balance sheets and income statements mean? Have you ever come across a conversation with your CPA perhaps, and they're talking about a cash flow statement, then you wonder, yeah, perhaps I should know what that is, but you don't really have a clue and you don't have the time to start researching? We're going to answer all those questions. Hang tight. This is a picture of a cockpit of an airplane. Tons and tons of gauges. I'm sure you can see them. So yes, some of these gauges are very, very important, like the altitude and the attitude indicator, and certainly a compass and weather radar. And others probably not. It probably has here a gauge for the temperature in the aft toilet room. Yes, important for some, but probably not that important to get the plane where it needs to. Now, the interesting thing is that pilots get a lot of training to understand how each of these gauges work. But most importantly, they get a lot of training in understanding how the information that each one of them combines to give them a picture of what really is going on. For example, if there is a wing level indicator and also a descending altitude, well, it means that it's falling at an angle, and so on and so forth. Each one of these gauges is very, very important. By now, you probably know where I'm heading with all this. So a company's gauges are much more sophisticated than just asking your bookkeeper what were the sales last month, or how much were the expenses, or what was payroll. Each one of the statements, the gauges in our company, has a job. And the important thing is to understand not only what information each one provides, but also to understand what information the combination of this of each one of these statements gives us. So why don't we just go straight into it and have a look at what they mean. Probably one of the most famous ones, and that is the balance sheet. Abbreviated BS. Some people say that there is a reason for that abbreviation. In any event, here on the left side are our assets. On the right-hand side, we have liabilities, and here net worth. What does all that mean? Quite simply, assets refers to stuff. Liabilities refers to anything I have to borrow to get that stuff, and net worth is what the shareholders have come up with, either initially or over time, to also finance and buy those assets. Here's a very interesting concept. The right-hand side pays for the left side. So they always have to balance. The asset side has to be equal to the sum of liabilities and net worth. Now, the important thing about the balance sheet is that it shows us a picture in time. It doesn't show us what happened during the year. It just shows us of a picture in time. So for example, you might have typically a December 31st balance sheet that shows you the picture at the end of the year. Now, what do accountants and CPAs and bookkeepers look at in a balance sheet? Well, they look at the relationship between the different big chunks of the balance sheet, for example, between assets and liabilities and so on, but also at the relationship between the smaller parts within the balance sheet. So within the assets, for example, we're going to have here cash, and we're going to have accounts receivable, and we're going to have inventory, and so on and so forth. And within the liabilities, we're going to have, for example, short-term liabilities to vendors. and so on and so forth. And within net worth, we're going to have monies that the shareholders came up initially, and hopefully we will also have a section here that is the profits that the company accumulated over time. So again, what we're going to be looking at here is the different relationships between the different subsections of the balance sheet. A very common one to look for is the relationship between short-term assets and the short-term liabilities. Which is bigger? Hopefully, the short-term assets are bigger than the short-term liabilities. The most important juice we can get out of the balance sheet is not just looking at one static picture, but rather comparing it with a balance sheet from a previous time period. It could be the previous month, it could be the previous year, it could be the last 5 years. But looking how the different parts of this balance sheet evolved over time, that's where we get the most juice out of it. Let's go to the next one. This one is probably the most famous one, and that is the income statement. The income statement is the most famous because it's the one that everybody understands in their gut. Did I make a profit or didn't I make a profit? Personally, for me, in my experience over 20 years, am I interested in the income statement? Yes, but not that much, and you'll see in a second why. Let's look at the big component of an income statement. The income statement, first of all, always measures the results over a period of time. So it could be annual, it could be monthly, it could be quarter, it could even be per week, depending on the business that we're looking at. But it also always measures the results of the operation over a certain period of time. So the top line, as you probably know, is sales. Income, it has different names, but typically it would be sales. From that, we subtract the cost of goods sold or services provided. If it's a service company, then it would be cost of services. That gives us what we call gross margin. This number is very important. We'll see why in a second. From there, we subtract overheads, which give us a net profit. Now, here's the interesting thing. Sales, everybody knows what sales are. Cost of goods sold is typically the cost of the goods that go directly into the product or the service that we're offering. For example, if I would be selling pens, then it would be the plastic, it would be the ink, it would probably be also the labor, the direct labor to produce this, and including most likely the freight to the warehouse, the cost of the warehouse, and so on. But it's everything related that goes into this pen to make it available to the customer. That gives us the gross margin, and that very often is measured also in a percentage. So you will hear people asking, what kind of gross margin are you working with? Why is that important? We'll address that in 30 seconds. Overheads, that is basically the cost of running the operation that is not directly involved with this pen. For example, the lease of your facility, what you pay your bookkeeper. All those expenses are there regardless of whether you sell $1 million, $10 million, or nothing. They will be there. That's typically what you understand by overhead. And then you obviously have a net profit. Now, why is gross margin important? Well, let's look at the extremes of gross margin. Let's say that you have a very, very good gross margin, let's say 50% gross margin, that is a good number. Why? Because it means that out of every dollar that I increase my sale, okay, 50 bucks, 50% of that goes to my gross margin. And here's the interesting thing. To the extent that I keep my overheads more or less constant, a lot of money is going to flow down to the net profit. So having a good gross margin, I would say, guys, is super, super important. What happens in the other extreme if you have a very tight gross margin, let's say 3%, 5%, you're probably in that case dealing with a commodity, and in commodities, it is volume. If you do not have the volume, you're toast. So you need to have lots and lots of volume, and it's probably an industry where price is the determining factor. So that is your income statement. Now, let's talk a little bit about this one here. I wonder whether you know which one I'm referring to. This, in my mind, is probably the most important statement, and it's never mentioned. Now we're going to see why. This is the cash flow statement. And it's crucial. Cash flow statement measures whether this company produced cash flow or sucked up, consumed cash flow. Why is that important? This is a crucial concept. You can be profitable. You can have a profit. If you do not have good cash flow, then you can be very, very profitable, but you're very, very bankrupt. So being able to manage this is key. Let's see what the different components of a cash flow statements are. The cash flow statement is divided into three different sections. Operating cash flow, which has an initial situation, an ending situation, and a final situation. The outcome of these two can be positive or negative. We have a financial cash flow, again with a beginning and an ending situation and an outcome. Did it produce or didn't it? What do these all mean? Well, operation means how much cash flow am I producing from just buying and selling pens? Now, you might wonder, well, what other kind of cash flow can a company have? Well, that's the second one, financial cash flow. If you pay down debt, you're using cash to pay down debt. That consumes cash. If you're borrowing money, that gives you cash flow. It has also impacts other parts of your balance sheet, but those are situations where you would have changes in cash flow depending on whether you pay down debt or you create more debt and borrow. The third one is what we might call cash flow that has to do with the purchase or the sale of equipment and assets. As the name implies, when you sell equipment or you sell assets or purchase assets, that has changes, implies changes in your cash flow. And all of that obviously has a final result at the end, which is the final cash at the end of the transaction. So it's made out of the operating, financial, and equipment or assets, and it gives you a final result. By the way, you might be asking, how do these three statements relate to each other? Well, this final cash flow happens to connect with this one, which is the balance sheet. That's the cash situation at the end of this fiscal year. Now, why did I tell you that the income statement is not such a good statement, at least for me. And the reason is that this is theory. In other words, it doesn't really tell you what is going on with the company. It tells you, yeah, if the company is making a profit or not making a profit, but the reality is that this is a model to see whether the company is pricing its products properly. If we have a loss here, then we got other problems as well. But the reality is that if you see a net profit here, that does not necessarily mean that you got a good cash flow statement. Let me go back perhaps to this analogy of the cockpit. The fact that we're heading in the right direction does not mean that we have the right altitude. We might be heading in the right direction to reach our destination, but we might be flying too low and we hit a mountain. Or we might be flying at the right direction and at the right altitude, but we ran out of gas, right? This is running out of gas. So please pay attention to all these statements. I invite you to look very, very carefully at the cash flow statement. It is not something that people look at it very, very closely. CPAs don't want to explain it, but it serves you, it would be very, very important for you to keep an eye on it. One final thought. A lot of people depend on you. Not only your family, but also your staff, and may I include your clients that are benefit from your products or services. It is very, very important that you get your arms around these statements. Ignorance is not bliss in this case. Ignorance is dumb. So please look at these statements, understand them properly, and feel free to give me a call or connect with me. I'd be happy to address these. Leave me your comments on, tell me what you're interested in, and please subscribe to this channel so I can continue giving you videos for free and good information for free. And remember, when you control your cash flow, you can stop stressing and start enjoying what you're doing and start growing the business. See you next time.